Hey there, savvy investors and curious minds. Today we're talking about how to turn small investments into massive returns. Stick with me, because we're about to unpack some wisdom from one of the greatest investors of our time, Charlie Munger. This is the Finance Virtuoso channel. If you're new here, hit subscribe and the notification bell for the best money tips and tricks. Before we jump in, let me be clear. Investing always carries risks, and there are no guarantees in the world of finance. But by understanding and applying some key principles, we can significantly improve our chances of success. So, let's get started. First up, let's talk about the myth that you need a ton of cash to start investing. Charlie Munger, the right-hand man of Warren Buffett, has some pretty interesting thoughts on this. In a recently unearthed video clip, Munger discusses how he believes it's possible to generate annual returns of 50% when working with smaller amounts of capital. We're talking under $10 million here, which in the world of big finance is considered small potatoes. 50% annual returns? Come on, that's crazy talk. And you're right to be skeptical. These kinds of returns are extremely rare and definitely not typical. But let's dig into Munger's thinking and see what we can learn. Munger emphasizes three key principles for generating high returns on small sums of money. Let's break them down one by one. Principle number 1, look for inefficient markets. This is where things get interesting. Munger points out that Berkshire Hathaway's massive size, we're talking about the 9th largest company in the world by market cap, is actually a disadvantage when it comes to generating high returns. Why? Because they're forced to focus on large investment opportunities, which are less likely to be mispriced or inefficient. But here's where you and I have an edge. Smaller investments, the ones that fly under the radar of big investors, are much more likely to be inefficiently priced. These are the hidden gems that could potentially yield those mouth-watering returns. So, how do we find these opportunities? Well, thankfully, we're living in the age of the internet. You don't need to spend thousands of hours poring over financial reports like Buffett and Munger did back in the day. Instead, you can use online stock screeners to filter for potentially undervalued small-cap stocks. Here's a quick tip. Try setting your screener to look for companies with market caps between $10 million and $200 million, and P/E ratios between 3 and 15. These parameters can help you find smaller companies that might be flying under Wall Street's radar. Remember, the goal here is to find companies that are too small for big investors to bother with, but still have solid fundamentals. It's in this neglected corner of the market where real opportunities might be hiding. Principle number 2, take big swings when good opportunities arise. Alright, let's shift gears and talk baseball for a second. Stay with me here, I promise this connects to investing. Munger likes to use the example of Ted Williams, one of the greatest baseball players of all time. Williams wrote a book called The Science of Hitting, where he broke down the strike zone into 77 cells. He knew that by waiting for a pitch in his sweet spot, he could increase his chances of getting a hit from about 25% to around 40%. So, what's the investing takeaway here? Patience is key. Just like a great batter waits for the right pitch, a smart investor waits for the right opportunity. Munger believes that in investing, you might only get a handful of really great opportunities in your lifetime. The trick is to recognize them when they come along and then, this is crucial, act decisively. When you spot that perfect pitch in the investing world, that's when you swing for the fences. Don't be afraid to invest a significant portion of your capital when you find an opportunity that you've thoroughly researched and strongly believe in. But here's the catch, and it's a big one, these perfect pitches don't come along very often. It might be months or even years between truly great opportunities. That's why it's so important to make the most of them when they do appear. Principle number 3, don't be afraid of a concentrated portfolio. Now, this is where Munger really goes against conventional wisdom. We've all heard that we should diversify our portfolios, right? Spread our investments across lots of different stocks to reduce risk? Well, Munger begs to differ. He believes that if your goal is to generate high investment returns, a highly diversified portfolio might not be the way to go. In fact, Munger himself has the majority of his family's wealth in just 3 investments: Berkshire Hathaway stock, Costco stock, and a fund managed by an investor named Li Lu. Munger's argument is that by focusing on a handful of businesses that you really understand inside and out, you can make more informed decisions and potentially achieve better returns. It's about quality over quantity. He likes to tell the story of his friend John Arrillaga, a billionaire real estate investor. Arrillaga made his fortune by focusing exclusively on real estate within 1 mile of Stanford University's campus. That's right, he didn't diversify across different types of real estate or different locations. He stuck to what he knew best and became incredibly successful as a result. Now, I can hear the alarm bells ringing in your head. Isn't that incredibly risky, you might be thinking. And you're not wrong, a concentrated portfolio does carry more risk. But Munger's point is that if you really know what you're doing, this approach can lead to outsized returns. Of course, this strategy isn't for everyone. It requires a deep understanding of the businesses you're investing in and the discipline to stick to your guns even when the market gets choppy. But for those willing to put in the work, it can be a path to potentially higher returns. So, what does all this mean for you and me? How can we apply these principles in our own investing journey? First off, don't be discouraged if you're starting with a small amount of money. In fact, that might actually be an advantage. Use it as an opportunity to look for those inefficient, under-the-radar investments that the big players can't touch. Secondly, be patient. Don't feel like you need to be making trades every day or week. Wait for those perfect pitches, those investments that you really understand and believe in. When they come along, don't be afraid to take a big swing. And finally, consider the merits of a more concentrated portfolio. This doesn't mean putting all your eggs in one basket, but it might mean focusing on a smaller number of investments that you really understand well, rather than spreading yourself too thin. Remember, though, that investing always carries risks. These principles aren't a guarantee of success, and you should always do your own research and consider your personal financial situation before making any investment decisions. Before we wrap up, let's recap the key takeaways. 1. Look for inefficient markets. Smaller, overlooked investments might offer better opportunities. 2. Be patient, but act decisively when great opportunities arise. 3. Don't be afraid of a more concentrated portfolio if you really understand what you're investing in. There you have it, folks, Charlie Munger's wisdom on turning small investments into potentially massive returns. It's not an easy path, and it's certainly not without risks, but for those willing to put in the work and think differently, it could be a game changer. What do you think about these ideas? Are you ready to apply some of Munger's principles to your own investing strategy? Let me know in the comments below, and don't forget to like and subscribe for more investing insights. Until next time, happy investing, and remember, in the world of finance, sometimes thinking small can lead to big returns.